Interest rates have absolutely dominated the headlines this year, but today we're looking at some information that might show that there's some relief on the way for interest rates.
I keep it real, I keep it real, I keep it real, just keep it real.
Hey guys, thanks for joining me for another real estate deep dive. I'm Sam Hartman, keeping it real estate right here in Fort Wayne, Indiana. And the deep dive is all about grabbing real estate topics of the day and going a little bit deeper than just the headlines, giving the headlines some context, some deeper data, some deeper information to try to help inform consumers like you and to empower you to make great real estate decisions for you and your family. So today we're talking about interest rates. Feels like we've been talking about interest rates all year because from January to today, interest rates have more than doubled from under 3% to now over 7%. And this has put a big strain on a lot of home buyers. It's put a strain on housing affordability. And we've all been looking ahead, trying to project what's going to happen with interest rates. And we've got some data and context to look at that might show there could be some relief coming sooner rather than later as far as it comes to interest rates, mortgage rates in the home buying process. I want to start with a quote by Dr. Lawrence Yun. He is the chief economist for the National Association of Realtors. And Dr. Yun says, a return to a normal spread between the government borrowing rate and the home purchase borrowing rate will bring the 30-year mortgage rates down to around 6%. So what is he talking about there? A return to a normal spread. Well, it's a pretty common misconception when consumers hear about the government raising interest rates. They correlate that directly to mortgage rates. But when the Fed increases rates, when you hear that as a headline, it's not actually increasing the mortgage rate. It's increasing the 10-year Treasury yield, which is correlated then to mortgage rates and interest rates for consumers. So let's look at a graph that actually shows how the 10-year Treasury yield correlates over time to that 30-year mortgage rate. You can see the 10-year Treasury yield is in blue, the 30-year fixed mortgage rate is in green, and you can see historically they're right there in lockstep. The historic average spread from the 10-year Treasury yield and the 30-year mortgage rate is 1.7. So if the 10-year Treasury yield is at 3%, then 30-year fixed mortgage rate would be close to 4.7%. That's what that's saying. And so you can see there, this is what we are calling that normal spread. 1.7 would be kind of the normal spread, but in recent times, they have kind of broken tradition of this lockstep correlation. And this year especially, we have seen mortgage rates actually go outside of this 1.7 and actually go even higher. So they aren't in lockstep, they aren't at a normal spread. And that is one of the reasons why interest rates rose so quickly, as high as they did as well. So here's what the 10-year Treasury yield actually did this year. And so you can see it's been on a rocket ship just like the 30-year fixed mortgage rate. It's just been rising from January to today until just recently. We actually see a little bit of reprieve where we actually saw a little bit of reprieve in the 30-year fixed mortgage rate as well. But still, that 30-year fixed is kind of extending past that normal spread. So you might be asking yourself, well, why aren't they within that normal spread? Why have mortgage rates risen more quickly than that 10-year Treasury yield that they tend to correlate and go lockstep with until just recently this year? Well, lenders are looking at this steep rise in the 10-year Treasury yield, and they're actually looking at it and charging a premium now to borrowers on that interest rate because they're viewing those loans as not long-term loans. They're viewing them as loans that buyers are eventually going to be refinancing, getting out of this loan product into a new loan product when those interest rates kind of temper down. So that is just one of the reasons that the rate is actually a larger spread than what is typical. And so where should they be if we were within that normal spread? So if we look at the historic average from 2000 to 2021, that's a 21-year time frame of data. The average 10-year Treasury yield rate was just under 3.5%, and the average spread difference was 1.79 during that time frame, which made the average 30-year fixed mortgage rate 5.28%. Now today, the average 10-year yield rate is 3.7, but the average mortgage rate is over 6.5%, 6.61%. Now that is a 2.91 spread difference. So you can see that's more than 1 point higher than what is typical in a normal market. So where should they be? Where, if it was in lockstep, if it was using the same correlated value, where would interest rates be? Well, if that 10-year yield rate is 3.7 with a 1.79 spread, interest rates should be right around 5.5%. And they're not. They're much higher than that right now. So we've seen recent softening in the interest rate. We've seen still volatility, but we've seen it come down some. And that is due to all of the data regarding inflation showing that the inflation is slowing. They're getting their hands around it and it's softening a bit. So the main reason that the government has been raising rates is they're trying to get their hands around inflation. Inflation's not a good thing for home prices, for the housing market, or for your pocketbook in general. Everything goes up in prices: gas, groceries, houses. But the government's trying to get their hands around this to try to curtail that steep inflation. And so because the inflation is showing signs of tempering, the mortgage rates are showing a bit of sign of recovery as well. Now, economically speaking, we still have a long way to go. I want to jump into a quote by Ali Wolf, chief economist with Zonda. She says the housing market is expected to face continued uncertainty heading into 2023 as consumers, financial markets, and policymakers work through their respective challenges in today's economy. So we are certainly not out of the woods. There is still certainly a lot of uncertainty in not just housing, but in the general economy as a whole. And so we're seeing positive signs in the economy right now, but certainly a long road to go. Now, I also want to point to the level of uncertainty that happened during the pandemic. Everyone really thought that the market was going to just fall out due to the pandemic. And although there was a really brief pause to the real estate market, it got lit on fire after that because people realized how important their house was. And so I'm looking at the demographics of the housing market right now. And although there is economic uncertainty, there's still going to be a high level of buyer demand going forward because there's just generations of people that have deferred home ownership that are now at their prime home buying years. And so that's not going to go away. Rising interest rates has tempered that and maybe put some of that demand on the sidelines. But as we work through these uncertain times, as we get to a place where people feel more financially stable, more comfortable, that demand's going to come right back. So I'm extremely excited and optimistic still about the take of the housing market, the state of our housing market, and how things will be going in the next few years. Next, I want to look at a quote by Barry Habib, MBS Highway. He's in the mortgage industry, mortgage expert. Barry says, because we see a slowdown and we see the inflation comparisons start to become more and more favorable, you'll start to see that inflation number move lower, 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 and lower. And as a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5% or below 5% even within the next 6 months. So that's extremely positive. Everyone wants projections. Everyone wants to know, hey, what do you expect in the near future? That's why I look to experts like Barry and like Dr. Lawrence Yun, because these guys are the experts. These guys have their hands around the pulse nationally as well. And so I rely a lot on these types of guys to help provide information to you, to make you feel comfortable, and to empower you. Finally, I'm going to finish with a quote by Bill McBride, the founder of Calculated Risk. Bill says, "My current view is inflation will ease quicker than the Fed currently expects." Bill, that's a great sentiment to have. The quicker that inflation eases, the quicker interest rates will ease, and we will get back to a bit better affordability in the market. We will get back to buyer demand rising as more buyers enter the market and have kind of deferred their home purchases because of high rates. All good news for buyers and sellers in real estate as a whole. So thank you for joining me on another deep dive. I hope this information was valuable and helpful in your home ownership journey. If you know of anyone that could benefit from this information, or if you found it valuable, please like, comment, share this information with others. I just want to make sure everyone is getting the deeper dive behind the scenes and the deeper information just behind the headlines, because headlines are created to terrify, but I am here to help clarify this data and information so that you guys can make great real estate decisions. I'm Sam Hartman, keeping it real estate. Thanks for joining me today. Have a great one.
Keep it real. I keep it real. I keep it real. Just keep it real.